If you invest using margin, getting a margin call can be stressful, especially if the markets are falling. But don't worry, understanding what it is and knowing what steps to take can help reduce that stress. In this video, I'll show you how to identify a margin call in your TD Direct Investing WebBroker account, and most importantly, ways to help resolve it quickly and effectively. But first, a quick refresher on what a margin call is. Simply put, it's when your investments have dropped in value, and by extension, the loan value you receive from your investments have dropped to a point where it is insufficient to cover your negative cash balance. So, how do you know if you're actually in a margin call? Open WebBroker, log in, and go to your account balances. Look for the line item called margin. This is your margin balance at the start of the day. If this number is positive, it means you have excess margin and are not in a margin call. But if this number is negative, it means you've started the day in one. This negative amount is how much margin your account is short by. The margin number on the screen is static, and it doesn't update as your investments change in value during market hours. To see your real-time margin, simply open a trade ticket, select your margin account, and you'll see a field called Buying Power. This number factors in the current price of your investments. But if you have access to Advanced Dashboard or Active Trader, your margin will update in real time on those platforms. Okay, so you've identified a margin call. What happens now, and why is it important to act quickly? First, when you're in a margin call, certain restrictions are immediately placed on your account. This means you generally won't be allowed to open new positions that require margin, and you won't be able to withdraw funds or securities. And if the margin call isn't resolved promptly, TD Direct Investing may sell securities in your account without notice to bring your margin back into good standing. The likelihood of TD Direct Investing needing to take action increases if your account shows significant risk factors, such as lack of diversification, holding high volatile securities, and having large negative cash balances relative to your equity. While TD Direct Investing does typically attempt to contact clients before taking such action, this is done on a best efforts basis and isn't always feasible, especially in fast-moving markets. So rather than waiting for a phone call that may or may not happen, it's always in your best interest to proactively manage your account and take immediate steps to resolve the margin call yourself. So how do you fix it? You have four primary options. Option 1. Make a deposit into your account. This is often the simplest way. If you're wondering how much, you would need to deposit at least the amount of the margin call that's shown on WebBroker. For example, if your margin call is $1,000, you need to deposit at least $1,000 Canadian. However, depositing extra to create a buffer is always a good idea. You can do this via WebBroker, EasyWeb, or the TD app. Option 2. Sell some of your securities. Your other option is to sell some of the securities held within your margin account. Selling positions does two things. It generates cash, reducing your negative cash balance or increasing your positive cash balance. And 2, it reduces your overall margin required by your portfolio. Keep in mind, though, that selling $1,000 worth of marginable stock, for example, often won't clear a $1,000 margin call. This is because the amount you need to sell depends on the margin requirement of the specific stock you sell. Let's look at an example. Assume you have a margin call of $1,000 Canadian. You decide to sell shares of ABC1 stock to satisfy the call. ABC1 stock has a margin requirement of 30%. This means it has a loan value of 70%. To figure out how much stock to sell, divide the margin deficit by the stock's margin requirement percentage. So in this example, you would need to sell around $3,400 worth of ABC1 stock to clear that $1,000 margin call. Remember to account for commissions if applicable. If you choose to sell a stock with a higher margin requirement, you get more bang for your buck and need to sell even less stock. Again, it's often a good idea to sell more than the minimum required to give yourself a greater buffer in case your portfolio continues to decline in value. Option 3. Transfer securities from other TD Direct Investing accounts. By transferring fully paid 4 marginable securities from other TD accounts, you increase the loan value in your account. The math to figure out how much to transfer is similar to selling a stock, but instead of dividing the margin deficit by the security's margin requirement, you use the loan value instead. Option 4. Cancel or edit any open buy orders. Open buy orders tie up margin, so by canceling them or reducing your quantity of shares, you might cover or reduce your margin call. It's important to end the day out of a margin call to get your account back into good standing. One way to do this is to check your real-time buying power towards the end of the market day after using one of these methods to cover a margin call. Facing a margin call can be stressful, but I hope that these tips help you feel more knowledgeable and confident enough to take control of the situation. Thanks for watching.
Have more questions? Check out the links to the right and in the description below.